Football finance. This edition of my podcast is looking at accounting issues and how they relate to football clubs. Now, this is a very topical issue. It's come up before in strategic business reporting, and in fact, it also has consequences perhaps for other examinations, for example, strategic business leader. Now, the reason it's an interesting area is because it touches on so many different accounting standards. I'm going to be talking about the framework, intangible assets, impairment, PPE, financial instruments, borrowing costs. And I think if you're going to look at a case study, or I think if you're going to look at a situation around football finance, it's good to have that holistic overview. But I'm going to deep dive into a little bit on player transfers and how they're accounted for. And I'm going to dive into also looking at new stadiums and improvements. Now, I guess one of the reasons why this area is so topical is because in the English Premier League and in Europe, we have something called financial fair play, where the regulations are that professional football clubs really shouldn't make year after year after year losses. And so how you account for transactions and events has an impact on the profit and loss account. And Everton, at the time of speaking, has been heavily penalised for too many losses. And Manchester City, at the time of recording, have an ongoing investigation. And there can be very serious financial implications should they be found guilty of breaching these rules. Okay, let's drill down into some football finance and drill down into player transfers. Now, professional footballers for Premiership clubs are employees of that club, and they appear, some of them appear as assets on the balance sheet. Now, this is utterly bizarre because if you work for a company, I guarantee you don't appear on the balance sheet of your employer as an asset, because the framework defines an asset as something that we control. And there was no monetary transaction when you signed for your company, when you joined your company, all right? So you don't appear, employees don't appear as assets on the balance sheet, but some professional footballers do. And that's because of the transfer market. That's because football clubs will pay, strictly speaking, they don't buy the employee, they buy the registration. They buy the player's registration to play football. And that registration is an intangible asset. It meets the definition of an intangible asset. So if, I don't know, Man City pay 50 million for a player and sign that player on a 5-year contract, the consequences on profit are 10 million a year, because they will amortize the cost of buying the player over the player's contract. Now, if they sign the player on a 10-year contract, then obviously the amount of amortization goes down, and so therefore you would only be charging a smaller amount per year if you've got a longer contract. And this is exactly what Chelsea have done in order to try and get round, or comply is a better way of saying it, comply with financial fair play regulations. Now, I've said not all footballers are on the balance sheet because not all footballers will have been bought by the club. I think of David Beckham at Manchester United. I think of Harry Kane at Spurs. I think of Tony Adams at Arsenal, if you like. These are players who came through the academy. These are players who were not transferred in. And therefore, because there's no reliable measure of the cost of acquiring the registration, they're off-balance sheet assets. Now, this is relevant when we come to sell the player. because Beckham was sold by Man United and Kane was sold by Spurs. What it meant was that the proceeds became pure profit because there was no cost to the football club of the player's registration. Whereas had they bought the player for 50 million on a 5-year contract and 1 year later sold that player for 55 million, the carrying value of that asset would be 40 million, 50 million less 1/5. If they're selling it for 55, then the profit on the disposal is only 15. Whereas if they had chosen to sell a homegrown player for 55, that 55 million would all be profit. So perhaps some of the financial influences in boardrooms look to say, well, actually, if we want to balance the books, maybe we should sell some of our homegrown players. Just putting it out there. What happens if a player breaks a leg? What happens if a player that you have purchased breaks a leg? Now, the accounting implications of that is that you would have to do an impairment review. That player isn't going to play anymore, isn't going to give economic benefit, may not be able to play for the rest of the season or for the rest of his career. And therefore you conduct an impairment review, potentially writing down the asset, potentially creating a charge through the profit and loss account. So injuries to players would be damages to intangible assets, would therefore trigger an impairment review under ISA 36. When players are bought and sold, the contracts for buying them and the consideration that is paid is not always a simple cash transaction. There can be deferred consideration. So you buy a player and say, well, look, I'll pay you 10 million now and I'll pay you 10 million in 2 years' time. And that then is deferred consideration, which would be measured at present value, would be discounted. Just like group accounts, really, when you buy a sub. There can even be contingent consideration. So we can get involved in ISA 37 and think about whether or not we're making a provision. So we could be liable, if we bought a player, to pay further amounts out if that player wins a number of caps for their country or plays a certain number of games. I certainly know that was the case when Dele Alli was signed for Everton. There was a further monies was going to be due if indeed he played a large number of games at Everton. Now, I think that's unlikely at the time of speaking, given his injuries. And so probably that is not part of the cost of the player, and that's probably not provided for because it's only possible that payment will be made under ISA 37, so a contingent liability. What happens if we have a player and their contract is running down and we want them to renew the contract and we pay them a lump sum to extend the contract? Matching concept. Yeah? If you've got a player coming to the end of the contract and you pay them 5 million as an inducement for them to sign a new contract over 5 years, that payment is made, but the cost of that goes through the profit and loss account over the extension of the contract period. Okay, so some of those are issues around player registrations, intangible assets. Yeah, you buy a player, you spread the cost of it, over the player's contract. You sell a player, you immediately post the profit between the sale proceeds and the carrying value. Old Trafford is falling down. That's the chant that is often heard at stadiums these days. And if the club is spending money on repairing, if the club is spending money on maintaining their stadium, that's a revenue expense, and that is immediately charged against profit. If, on the other hand, they build a new stadium, the cost of constructing that asset is capitalized because they are making PPE, ISA 16. International Accounting Standard 16, property, plant and equipment. You capitalize all of the costs relevant to making that asset. So the bricks and the mortar and the labor and the architect's fees and the legal fees wouldn't go through the P&L. They would be capitalized because you'd be creating a new asset. And if you borrowed money, if you specifically borrowed money in order to finance the construction, the interest on that debt would also be capitalized during the period of construction because the loan has been taken out in order to finance the construction, and therefore it's a directly attributable cost. So during the period of construction, interest, finance costs, borrowing costs, ISA 23, are capitalized when you're making your own asset. There is, of course, if you're raising finance to do such a capital project, you've got to make sure you get the right distinction between debt and equity. If you're issuing a financial instrument to raise finance, it'll be debt if there's an obligation to pay the money back. And so that also catches things like preference shares where you're required to make payments, and scenarios where there are sort of put options that the person who's lent you the money has an obligation or has the option of forcing you to pay the money back. That would be classified as debt. Talking of stadiums, where does Arsenal play? The Emirates. Where does Manchester City play? The Etihad. So both of these are airlines. They have sold they've sold sponsorship rights. Manchester United continue to play at Old Trafford. Chelsea continue to play at Stamford Bridge. They haven't sold the naming rights. But if you sell the naming rights, presumably there's a period of time to which that relates. So you might receive 100 million for a 10-year deal. In which case, that revenue is not 100 million today. You might get the cash 100 million today, or it might be spread. That's not relevant in terms, well, it's relevant in terms of cash flow. In terms of measuring profit, I would strongly argue the matching concept applies. So if you've sold the naming rights of your stadium for 100 million for a 10-year period, then you would drip that through the profit and loss account, over the 10-year period. I think Spurs have still yet to get round to selling their naming rights. They were trying to do so. Now, how am I going to wrap this up? How am I going to conclude this? I'm going to mention integrated reporting, because I think football clubs are an interesting example of businesses which are not judged exclusively by the amount of profit or loss they make. They're judged by the cups they win and the players they have and the goals that are scored. And, when you think about the academy bringing players through, that's about investing in employees, and that needs to be reported on. That's one of the if you like, key performance indicators around a successful club, that they've got a successful academy that brings the youth. It makes a connection with the fans. It's a lot cheaper than going out and buying players. And then, of course, they can be sold at a great profit. So football clubs are a unique example in this country of a kind of social enterprise where communities and season ticket holders really feel they own the club, really feel they have a stake in the club. And so there is an element there of accountability. And the directors, I think, should be ethical, in the way that they comply with the financial fair play regulations. They should act with integrity. Remember, one of the 5 key pillars of ethical behavior is acting honestly, following the spirit of the rules, acting with integrity, because football should be fair. You shouldn't be able to buy success. That's the cliche. That's the story. So thank you for listening. This has been a brief discussion around some of the issues around football finance that are relevant to ACCA students, particularly SBR, but also perhaps in other papers as well. Thank you very much.